think we're ready to get started. I want to thank everyone for taking the time to join us this afternoon for another edition of Public Leadership Institute's Policy Leadership seminars. This topic, I'm going to introduce our special guest that we're very fortunate to take time out of his busy schedule to be with us to talk about a topic that is, without question, part of the national presidential debate, and most pressing, a top issue to young people who are shouldered with tremendous amounts of student debt as they're just starting out in this world. We're going to be talking about innovative state laws to actually ease the burden of that debt. My name is Dave Woodward. I'm going to be your host today. I'm the National Network Director for Public Leadership Institute, in addition to being a local county official and former state legislator. I want to welcome everyone to being part of this session this afternoon. Just a little bit of background for those, a few folks who might be new and joining us. Public Leadership Institute is a nonprofit, nonpartisan policy leadership center that's sole purpose is to raise awareness around key policy issues that we'll be talking today, particularly around the areas of equity and justice, and to develop leaders who are going to improve the economic and social conditions for all Americans. And you can find a lot of information about Public Leadership Institute at our website at www.publicleadershipinstitute.org. And you're going to also find a host of publications around policy, messaging, and so forth on that website, free for download, that we hope and encourage you'll download and put into practice as we try to move the needle in the direction of advancing political and progressive political policy change across the country. Before we jump right into the presentation, I want to just point out some tools that are available on your control panel to maximize your participation in today's session. Specifically, we really want to make sure that your voices and questions around the stuff that we're going to be talking about today around easing student debt is addressed. We have a number of ways that people can participate. If you click on the hand icon on your control panel in your GoToWebinar control panel, at a time appropriate where we pause for questions, we'd love to bring your question live, and frankly it becomes a more enriching experience for all of us the more people who participate. I realize that people join us from a variety of locations, and sometimes it's easier to type questions in the question bar. Feel free to do that as well. I will make certain that as many of those questions get answered as long as we have time for. And you can always email me at dwoodward@publicleadershipinstitute.org. I will try to get to those. It was a little challenging during the presentation, but if there are questions for any of the presenters that you want more information, I'd be happy to collect those and make sure we get that answer to you. So without any further delay, I want to introduce our special guest, who is the sponsor of legislation in the great state of Connecticut, State Representative Matt Lesser, who's taking time out of his busy schedule to be here with us today. Matt, thank you for joining us.
Thank you for having me, Dave.
All right. So I'm going to hand over control to you. There you go.
Okay.
And we can see your screen. And why don't you just take us away? I mean, it's like setting up the problem, and more importantly, I think a lot of people here are interested in having the conversation around how Connecticut's improving the conditions for those who are shouldered with all this incredible level of student debt.
Well, thank you very much, Dave, and I'm glad we're able to get the technology to work. If there are any issues, I hope somebody will point them out. But it's a really important issue. I think everybody who's on the call knows why. And although the focus has been on the federal level and the need for federal level reform, there's an awful lot that states can do and are doing to try to combat it. And before I go any further, I do want to mention we should have my friend and colleague Subira Gordon on the phone. She is the Executive Director of the Connecticut Commission on Equity and Opportunity, which helped us with the legislation. Subira, are you there?
Subira's online, but her audio doesn't seem to be
Yep,
working.
I'm here.
There she is. There she is. Perfect. Hi, Subira. How are you? Thank you for joining us, too.
So Subira was the leader of the Higher Ed Not Debt Coalition, which worked in Connecticut, which was, incredibly important in helping us formulate the legislation and pass it. So we wound up passing two major pieces of legislation in 2015, the last legislative session, both of which went into effect this year. And the general lay of the land, that student debt is closing in on $1.4 trillion. It's the largest unsecured source of debt in the U.S. And is a growing problem, not just for millennials, but I believe I saw a statistic that it is the fastest growing reason why Social Security checks are being garnished, because of loans that have been co-signed by parents or grandparents. And it is having a macro effect on the economy. There have been a couple of studies that have shown that high student debt levels are delaying the purchase of homes, which has an effect on the housing market, also affects the ability of people to take risks like starting new businesses. So it has an enormous effect on the economy. And in Connecticut, we looked at the numbers, and we are the sixth highest debt level of any state in the country. And when I was appointed chair of the banking committee in January of last year, felt that this was an important issue that we needed to tackle. So I'm a millennial myself, and this is an issue that we decided to go at from a number of different ways, and so it was great to partner with a Higher Ed Not Debt Coalition. One of the things I think to point out is that it's not that there's a student debt crisis; it's that there are several different things that are going on, and one of the I think things that's quite interesting is that although we're certainly familiar with people who have many hundreds of thousands of dollars in debt in some cases, generally speaking, the higher the debt level, the lower the default rate. And so higher debt levels are often associated with people with professional advanced degrees, and lower debt levels are often associated with people who've dropped out of college, who are associated with communities of color, people lower down on the economic strata, so for whom even a small amount of debt can often, because of the fact that student debt is not something that is forgivable in bankruptcy, can be a major millstone around the neck of borrowers. There's a great tool from the Center for American Progress called Mapping Student Debt that allows you to see the average debt level in your zip code and also the default rate. So we put together a coalition last year that did get enormous bipartisan support to tackle what I hope is both of these issues in a couple of different ways. One of them was by overhauling Chasma, which was we have an existing state student loan issuer. This is our Supplemental Student Loan Authority. Last year, they were basically issuing loans at the same rate as the federal Parent Plus loans. We passed two main bills. One was overhauling our Chasma program, and the other was a student loan bill of rights. The Chasma program was focused on a couple of different issues. One was we wanted to make it possible for students to refinance their loans, and two, we wanted to make those loans more affordable. When the state borrows money, we get a very favorable rating. We have a good rating from the rating agencies, and we were lending at 6.75%, even though we were borrowing in the 2 to 3 range, and so the spread was quite enormous. And so we put pressure on those state authorities, forgive me, to cut their margins and expand the debt-to-income ratio that they were looking at to allow more middle-income families to qualify for loans. The Student Loan Bill of Rights, on the other hand, was designed to make the process work better for everyone, regardless of whether they borrow through the state of Connecticut, through a private borrower, or as most borrowers do through the feds. I'll turn it over to Subira now to talk about the Higher Ed Not Debt Coalition.
Hi, can everyone hear me?
We can.
Hello?
You can come
Okay,
through
all
loud
right,
and clear.
great.
Yeah.
All right, so this is an issue that is very important to me. I used to work for the African American Affairs Commission, and prior to coming into this position, and if you look at the levels nationally, and it's also true for Connecticut, African Americans tend to be twice as likely to have to borrow for college and borrow twice as much, so which means they end up to be twice as likely in debt. So this was very important to me and for my office. I worked for the African American Affairs Commission to make sure that a lot of these conversations are happening, I think, around the country, but a lot of them don't necessarily involve communities of color. So we put together this coalition of legislative commissions, labor unions, community organizing groups, and consumer advocacy organizations to really move this issue in a coalition of, I call it, unlikely partners. And we kind of came up with some principles that meant a lot to this coalition, where no matter what happened, that we all were going to stay true to the fact that we believe that student debt is, I'm also a millennial like Matt, probably one of the largest issues facing our generation. So it was, it was a heavy lift, I think, to get the group together, but once we were able to get ourselves organized, we kind of understood that this was something that I think it matters to millennials, but it also is a huge issue to parents of millennials, which is why we were able to bring a broad coalition here, because a lot of parents are paying for student loans and will be paying for those student loans, and not seeing themselves being able to retire because of the heavy loads of debt. So we kind of worked together and worked on, we believe, I think in a bigger sense, on a lot of other issues such as rights of students on campus and so on, which is kind of what brought us together. But our real base was that we thought that students should be leaving college and not be carrying heavy loads of debt. And then, so Representative Lesser was very helpful in moving this along in the legislature. So on the outside, we did a lot of community organizing and building a coalition around individuals in communities that saw this as a very important issue.
Great, thank you, Subira. So we had the political support right off the bat from Higher Ed Not Debt, and we went to legislative leadership and made the case that we needed this to be one of the core accomplishments of the legislature in the 2015 session, and received early support and an early commitment to do something on the issue of student debt. The other thing that we were surprised to find was real strong bipartisan buy-in. My Republican ranking member, I'm a Democrat, and my Republican ranking member has a photo of him and George W. Bush and Ronald Reagan on the wall of his office, and yet he, talked about how frustrated he was as someone who had co-signed his son's student loans and wanted to be part of the solution. And so we did get bipartisan support throughout the process, which was really critical, because we were able to relate to Republicans who have to pay the same student loans that Democrats do. So the other, I think, beyond just the high cost of debt, and certainly the the acceleration and the cost of the inflation in the higher education market that we're up against is the fact that since over the last few years, the student loan servicing environment has been largely deregulated. And so companies like Great Lakes and Navien dominate the market, mostly under contract with the U.S. Department of Education. But there is enormous dissatisfaction with the ways that they do business and the fact that there really isn't an active regulator in the market for people who have complaints. And that contrasts with the way typical home mortgages work or other kinds of debt, which are often regulated. And in fact, one of the first things we did, and this was in the Student Loan Bill of Rights, was look to pattern rules for student loan servicers, the companies that collect the student debt, after rules that we had applied to mortgage servicers in the wake of the housing crisis. So, huge levels of abuse lead to dissatisfaction. What we are requiring student loan servicers to do is register with our state's Department of Banking and adhere to basic servicing standards. If they don't, they can lose their license to collect their ability to service debt within the state of Connecticut, and they can be subject to other punitive actions. And what we're doing as well is we set up an Office of Student Loan Ombudsman, and this is something within our state's Department of Banking, an office that helps, when it's fully established, will help assist borrowers and families in disputes with student loan servicers, and also provide financial education to find more affordable options as people work to reduce their debt levels. That is funded, it will be funded through assessments on the servicing companies themselves. Initially, we were funding it through fees, but have switched to an assessment model, which is one typically used by departments of banking and insurance around the country. As well, we just had a major settlement with a bank earlier this week, and it's my understanding that as part of that settlement, that bank is making a payment of $250,000 into the student loan servicing account. We're in the process as well of creating a single financial education portal for students to find options. That should be out within a couple of weeks. So then back to the refinancing. We created a new program called Refi-CT. Initially, as I mentioned, student loan rates were tied to Parent Plus loans, and they were last year they were being issued at 6.75% for new loans. Although we didn't include legislation forcing our authority to lower their rates, the threat of a cap in the legislation persuaded our authority to lower their rates almost two full percentage points to 4.95% for new loans, and expand, as I mentioned, the debt-to-income eligibility requirements to allow more families to qualify. It doesn't make sense for states to profit off of student loan issuance, and it doesn't make sense to have a program if only the wealthy can qualify. In addition, we created a refinancing model for loans. It works very well for federal Parent Plus loans. It is more difficult for some other types of federal and private loans due to some IRS rules. You need to find documentation to show the net education cost. But that is something that just went into effect the end of June, and we're refinancing amounts of up to $100,000 per loan. it also allows borrowers to refinance state loans as well. On refinancing, we have terms of 5, 10, and 15 years. As I mentioned, it's dependent on credit score, but it can be with a cosigner. It can be as low as 4.25%, what we're refinancing down to. And I think that concludes the slide, but I want to turn it over to you to see if you have questions about either the politics or the policy that we were able to put through. We're still looking for new ideas about how we can take action on the state level, but this was a great opportunity to get something done, and I think we passed almost unanimously. Both bills passed almost unanimously through the legislature, and servicing is effective as of July 1st. All servicers are now registered with the Department of Banking through the Student Loan Bill of Rights, and the refi was just started, I think, on June 28th. So both programs are very new, but they are in effect, and so far they seem to be working.
Great. And this would be a great opportunity for anyone who's on the phone and joining us around the country to ask your questions. You can either type questions in the question bar. If you have audio capabilities where you are, raise your hand and we can unmute you. But this is, I mean, I think it's an example of a way that states can really chart a course to, measurably improve the conditions on individuals, and in many cases, full communities who are harbored with this incredible student loan debt, and frankly holding them back from becoming active players in the respective community, local economy. So, Representative, and I'll throw the first question out. These types of reforms, how do they compare across the country? I think it's, just taking advantage of low interest rates in general and being able to try to put pressure to lower those rates. How does your leadership and your legislation and Connecticut's action, how does it compare to other states? And is there a conversation happening among states to figure out how to tackle this problem?
I think there is. I think that there are other states that have pursued other options, like making student loan interest tax deductible, which is a perfectly worthwhile discussion. And there's a larger question about state disinvestment from higher education, and this does nothing to address that larger question of why is it that students are in never higher amounts of debt. But I think what we did was well targeted in the sense that by regulating the servicers and providing assistance through our Ombudsman's office, that's something that benefits anybody with student debt, and I think the refinance and our lower interest rates will disproportionately, or certainly better, target people who are at the lower end of the income scale. I think what we've seen is for people who are, let's say, radiologists at the higher end of the income scale, there's a growing number of private actors who are providing refinancing options to that community, and I think it would be a poor use of taxpayer funds to focus on the very cream of the crop. Unfortunately, I think a lot of the student loan interest deductions disproportionately affect the very wealthy.
Mm-hmm. Got a question here from George. George, you there? Oh, there he is. George?
Oh, now you can hear me.
Now I can hear you. Perfect.
Now, I'll explain a little bit about my background. I'm a banker in North Dakota.
Mm-hmm.
I have 2 children that have graduated from college with student debt, And North Dakota is the only state in the nation with a state-owned bank. And a few years ago, the bank started issuing its own student loans. But when my son graduated from an out-of-state university in 2012, I tried to get the bank to consolidate his loans and put him under a program that he would have one payment. And he had some federal debt and he had some of this state debt. And they said they couldn't do it. So in the 2013 session, I put together a bill with some other university people, university senators that allowed the Bank of North Dakota to consolidate debt and start a pilot program of loan consolidation. They call it the Deal One program, and you can probably find it online. What they're doing today is they're consolidating student loans for any resident of North Dakota that has a provable credit rating, and they're doing it at less than 2% interest on a variable rate, and on a fixed rate up to, I think, up to 20 years at about 4.25%. And they started that program got it really going in 2014, and to date they've refinanced over $400 million of student loans in North Dakota. It has been wildly successful, but we're trying to figure out how to make it better. One of the things we're talking about is, because this money is paid to the state, and the state is making money on these students, why can't we give some of these people a tax credit? Have any other states talked about that? Giving them, if you have a state income tax, and I believe there's 40 to 44 states that have a state income tax, could we give us a tax credit for $500 for a certain percentage of the interest that students pay? And what other programs can we do? Because we know the bond that our states that have good bond ratings can get money fairly cheap on the market today.
So George, yeah, okay. So George, you're throwing a lot out there. Let me give the representative an opportunity to kind of maybe address some of those points in context. And George, thank you for your question.
Well, George, thank you very much for your question, and thank you for your work. It sounds like you have a program that certainly rivals ours in rates and may beat us. I think there are. I know that a number of states are looking at the tax credit issue, and Connecticut is as well. I think the question is making sure that they're targeted well for the people who you want to serve. And as I think we sort of mentioned earlier, there are different issues depending on what community that you're trying to get to. If somebody who borrows a small amount of money to go to a state school and has let's say $3,000 of loans, may be an enormous amount for them if they wind up dropping out, for example. And that's a very different set of issues for somebody who's if you're trying to attract a doctor to your state who's just graduated from medical school with a much larger loan amount. So I think that those are important questions, and we're looking at them ourselves for the next session. And I just want to make sure that that we make sure that those two sets of issues are not conflated. I also just want to point out one potential pitfall with state financing is that the federal government has a number of important loan deferral and forgiveness and forbearance programs, some of which are very important, for teachers and for many other folks. And at least in Connecticut at the moment, we do not have those options on our state refinancing option. I don't know if the Bank of North Dakota has one, but that is an important consideration as well, because although it is a good option for many people, it won't work for everybody.
Right, great. I got a question from Mary out of Georgia that was very interested in the financial literacy and the Ombudsman in the Department of Banking that is being created and funded. And she asks a question specifically, at what stage is like the financial literacy being presented, particularly to give warning to individuals taking out loans for, and in her word, paper mill universities. And we know these for-profit entities, particularly these online for-profit entities that are very much targeting a specific constituency, driving up huge amount of debt, arguably not having a huge impact of improving their economic position. So I don't know if you want to speak to that as it relates broadly around this consumer protection components that created some of your legislation.
Well, we're working on that, and I think we have the same issue in Connecticut, and I'm sure it's true in every other state. And I think that what we're working on right now is making sure that we have a single point of entry for financial literacy, and then we'd be looking at how we get that in front of every borrower prior to them signing up for what can be an enormous amount of debt. So we're hoping to roll out our portal within the next few weeks. And once we're satisfied that that provides sufficient information to students, we can then see about how to make sure that students get access to it. I mean, we've also done work in other areas as well on the financial literacy front in terms of making curricula available to high schools and to colleges in general. But I don't know that itself was enough to address the issue of a for-profit or maybe another disreputable organization with like marketing materials taking advantage of students and parents.
Right. If folks have any questions, I know some folks have joined us in the midst of the presentation. If you do have questions, you can raise your hand by clicking on the hand icon on the control panel or typing questions in the question bar. We're talking about state policy and innovative laws that can be implemented at the state level to help address and improve the student loan crisis in America. As the Representative Lesser pointed out, is the largest unsecured debt in America. I mean, have any classification, and these are ways of trying to figure out how to ease that burden, make it more manageable, so that particularly young people can actively participate in the economy. I have another question. And maybe Subira can also jump in. That you talked about the process of putting the coalition together. I think you lined up not only highlighting the problem, the conditions that made it, the political conditions being available to take on this, and more broadly this coalition. Where I guess this legislation has been passed, what's the next step? Is the coalition still intact? Is there a focus on new issues that are tangential to this, the broader student loan crisis issue being fixed? What the infrastructure that's been brought together to support that, is it also working on other things?
So yes, our coalition is still here, and we're actually going to meet next week. One of the things, I'm glad someone brought up for-profit colleges. For-profit colleges was kind of on our list of things to work on, specifically because of their predatory practices towards people of color and veterans. So not exactly sure what we'll be doing next session, but that's something that we're very interested in working on, and ensuring that those of our students in Connecticut who are the most vulnerable and the least able to afford it are not getting into debt for degrees that at the end of the day they can't use, or they've gone through a program and they can never get licensed in whatever it is that they've paid $40,000 for. That's something that's very important to us. And continuing to figure out how to educate people about the education process. Matt talked about the student loan education part. That's something that I think we're going to have to work very closely with universities and others, which is why it's very helpful having some labor unions who represent university professors at the table. We're going to have to figure out how to get the students to actually take that student loan education program, because it's very necessary. I think I've had many conversations with people who said, if I knew it was going to cost me X amount of dollars, I wouldn't have taken that extra $5,000 they told me I could get to help with my living expenses, which I think is where the student loan education program will be very helpful, especially for first-generation college students, which tend to be lower income and people of color. So we're still working. There'll be stuff happening next year. We haven't really come up with our agenda yet, but we're still going to stay working on this issue and continue to help Representative Lesser in whichever ways we can.
And I can say, in addition to that, I would echo, that the need to focus on the financial literacy component and find ways to, hone that and make sure that we can get that in front of students. The other part, and generally just beef up the ability of the student loan ombudsman to work hand in hand and provide hands-on assistance to families, and that's taking a little while to get up and going for a variety of reasons, mostly funding related. But we're working on making sure that we have that office to assist families. The other next step, of course, is the big elephant in the room, which is this state disinvestment from higher education. I think Connecticut's much better off than a lot of other states, but across the country, you've seen the rise in debt, directly linked to rise in tuition, and I think that is an issue that we're very keen on addressing. The president and at least one presidential candidate talked about free community colleges being an option. I know that some states are pursuing that, and we're looking at that very closely as a way to try to get at the debt level from the other end, which is preventing the debt from accumulating as much in the first place.
Great. I have a question here from Linda from Pennsylvania that kind of came up, I think, after Representative, you talked about like some of the federal programs out there, loan forgiveness tied to certain professions or certain other certain lines of work. In Connecticut, was there a conversation of addressing forgiveness issues, particularly moving people into high-need positions and that might not pay well, but we want highly skilled individuals in those positions because they serve an at-risk community or essential need?
Yeah, absolutely. We're looking at that. I think we see this as a problem, and just having general ability to. One of the things we're looking at is having a forgiveness option for as a way of incenting young graduates of ours. We're a state that educates a lot of folks who move out to our neighboring New England and New York, the states in New York, and so we're trying to find ways to incentivize young people to stay, and looking at forgiveness options, particularly in key fields, is one way to do that. And then the other is just this general lack of flexibility that we have in our current program, which means that you can't defer your loans for really any reason currently, and that's not something any other state should copy. That's just the way they designed the program, and we screwed up by not including that in it. So we're going to go back and try to find a way to include that.
Great. I got one more question here. If folks have additional questions, please type your questions in or raise your hand, and we'll take them up. Kenneth from Ohio, very interested in the Ombudsman office and asking that what is the projected cost to support an office like this, and will the assessment fees that you mentioned that will pay for it be enough to cover that expense?
Well, the fees are not. So because the field was so unregulated, we weren't sure exactly how many servicers there were. I think I got to check the latest numbers, but I believe we've had about 50 servicing companies register. They pay a fee of, I think, $1,000. $50,000 is not enough to operate. That's $1,000 a year. $50,000 is not enough to operate the office. So we're still trying to figure that out. By switching to the assessment model, we were able to determine the cost of the office and then assess each of the servicing companies relative to their share of the market. So if a Navien is 25% of the market, they would pay 25% of the cost, whatever that is. It's a little bit of a complicated question to sort of roll out, and when we get to a place where I'm comfortable telling you, where I'm comfortable with the cost, I'll tell you how much it is. But we're sort of negotiating that at this point.
Great. I'll make a final call for questions around some of the great work that Connecticut, under the leadership of Representative Lesser, and really a whole team of people who helped build the public support and political support to get some sweeping reforms in place to tackle this problem of student debt. If you have a question, you can type them in or raise your hand if you have audio ability. But I'm not seeing questions coming in because you, both of you must have done a tremendous job of actually addressing all the questions that have come up. And so I guess I'll give you some final comments or final words if you want to share. We'll wrap up here, and both of you have your contact information displayed there on the screen that people can reach out, particularly if you want to replicate a lot of this work. I think it's so critically needed, and I think it's what I think is great with both of you have been able to accomplish. Very complex issue. There are things we can do about it, and let's put those reforms in place to make things better for folks. But I'll give both of you the final word right now.
Well, thank you, Dave. I just appreciate the opportunity. No pride of ownership. Please steal our ideas. If you have better ideas, share them with us. We're looking for what we're going to do next session. So, shoot me an email if I can be helpful, and or if you have follow-up questions. And Subira?
Yeah, thanks, guys, for having us. And if you have any questions about coalition building and how to kind of build support around unlikely groups of supporters, I'd be happy to help. I think it's not a likely place where you'll see community organizing groups or civil rights organizations coming together on this, but I'd be happy to help whoever is interested. And my email is actually subira.gordon. There's a space there.
So there's a dot there.
Yeah, it's a dot. It's like Representative Lesser, subira.gordon.
Perfect.
If anyone wants to get in touch.
Well, Representative, thank you. Subira, thank you for taking time out of your afternoon to be with us. We look forward to continuing this conversation. I think it's so timely. I mean, like we mentioned before, it's definitely a theme in the national presidential election. But this is about getting real results for real people, and particularly our young people are trying to get into the workforce and trying to make it a little bit easier. So thank you for both of your leadership on this, and thank you everyone for joining. Take this information, put it into action. You've been given license to steal these ideas, and start these conversations all over the country. Thank you, everyone, and join us next time for another policy discussion every 2 weeks, same place, same location. Look forward to having you join us in the future. Take care. Bye-bye.